Intro. Welcome back to the channel. Today we are going to talk about one of the two most important approaches to analyzing stocks in the market: fundamental analysis. If technical analysis is about reading price charts and patterns, fundamental analysis is about understanding the actual business behind the stock. By the end of this video, you will have a clear understanding of what fundamental analysis is, why it matters, and what the key tools and concepts involved are. Let us get started. Section 1. What is fundamental analysis? Fundamental analysis is the process of evaluating a company's intrinsic value, what it is actually worth, by examining its financial health, business model, competitive position, management quality, and growth prospects. The core idea behind fundamental analysis is that every stock has an intrinsic value, a true worth based on the underlying business, and that the market price of a stock may be higher or lower than this intrinsic value at any given time. When the market price is lower than the intrinsic value, the stock is considered undervalued, a potential buying opportunity. When the market price is higher than the intrinsic value, the stock is considered overvalued, a potential selling opportunity, or one to avoid. The legendary investor Benjamin Graham, who was Warren Buffett's mentor, described this concept beautifully. He said, "The market is like a voting machine in the short term, driven by emotions and sentiment. But in the long term, it is a weighing machine, reflecting the true value of businesses." Fundamental analysis is the tool that helps you determine that true value. Section 2. Key financial statements. Fundamental analysis relies heavily on three key financial documents that every publicly listed company is required to publish regularly. The first is the income statement, also called the profit and loss statement. This tells you how much revenue the company earned, how much it spent, and how much profit it made during a specific period. The most important line on the income statement is the net profit, the bottom line that shows what the company actually earned after all expenses and taxes. The second document is the balance sheet. This is a snapshot of the company's financial position at a specific point in time. It shows what the company owns, its assets, and what it owes, its liabilities. The difference between assets and liabilities is called shareholders' equity or net worth. A company with strong assets, manageable debt, and growing equity is generally a financially healthy company. The third document is the cash flow statement. This shows how cash actually moved in and out of the business during a period. A company can show profits on its income statement but still be in trouble if it is not generating actual cash. The cash flow statement reveals the true cash generating ability of the business. Section 3. Key ratios in fundamental analysis. Fundamental analysts use several important ratios to quickly assess a company's valuation and financial health. The first and most widely used is the price to earnings ratio, or PE ratio. This tells you how much investors are paying for each rupee of the company's earnings. A high PE ratio means investors are paying a premium, expecting high growth. A low PE ratio may indicate the stock is undervalued or that the company is struggling. The second important ratio is return on equity, or ROE. This measures how efficiently a company is using shareholders' money to generate profits. A consistently high ROE over many years is a hallmark of a great business. The third ratio is debt to equity, which tells you how much debt the company has relative to its equity. A high debt to equity ratio means the company is heavily leveraged. which increases risk, especially during economic downturns. The fourth ratio is earnings per share, or EPS, which tells you how much profit the company earned per share. Growing EPS over time is one of the clearest signs of a healthy and growing business. Section 4. Fundamental versus technical analysis. A common question beginners ask is, should I use fundamental analysis or technical analysis? The honest answer is that both have their place, and the best investors and traders understand both. Fundamental analysis tells you what to buy, which companies are genuinely strong, undervalued, and worth owning for the long term. Technical analysis tells you when to buy, the right price level, and timing to enter a position. A stock that is fundamentally strong but technically in a downtrend may not be the right time to buy yet, and a stock showing a bullish technical signal but with poor fundamentals may not be worth buying at all. Combining both approaches gives you a significant edge.
You identify fundamentally strong companies using fundamental analysis and then use technical analysis to find the best entry and exit points. Outro. To summarize, fundamental analysis is the process of determining a stock's intrinsic value by analyzing the company's financial health, business model, and growth prospects. The three key financial documents are the income statement, balance sheet, and cash flow statement. Important ratios include the PE ratio, ROE, debt to equity, and EPS. Fundamental analysis tells you what to buy, while technical analysis tells you when to buy. And using both together gives you the most complete picture of any investment opportunity. If you found this video helpful, please like and subscribe for more content on stock markets and economics. Thank you for watching, and I will see you in the next one.